All right. Hey everyone, thank you for coming, the few of you who stuck until late. Today I'm going to talk about kind of like the first venture we're seeing into real world assets as collateral for DeFi. Brief introduction, my name is Gustav Arentoft. I spent around 3 years at the Maker Foundation doing BD in Europe and Southeast Asia. I'm still a contributor for the DAO itself, so I'm a contributor at the Maker Growth Core Unit. I also run a company called StableNode. I'm Danish myself, but I kind of got into crypto because I was living in Argentina, experiencing firsthand how on why we need assets like DAI to combat inflation. And then especially, like in the last 2 years, of course, like since multi-collateral DAI launched, I've been working kind of like the journey on getting these traditional assets into DeFi, so we can start, not just servicing the crypto crowd, but also working with traditional businesses. So today, I'll go over 3 different topics. I'll go through like what is currently happening in the space, the things that we're seeing right now, the onboarding process for these companies to actually be accepted as collateral, some of the active participants we are seeing in the ecosystem. We're also seeing an emergence of service providers, who is basically companies looking to help people get into these protocols. We look a little bit about like what will happen in the future, the growth that we're seeing at the moment, and then just some final comments. So right now, in April, we saw the first executive votes, which is basically like the final approval from the Maker community to onboard something, go through for some real world assets. The first ones that got onboarded, one of them is a Centrifuge asset for a company called New Silver, who basically does real estate bridge loans for real estate projects. And then we have another one called from a company called 6S Capital, which is basically a company who does credit tenant leases for commercial real estate, both of them in the US. Right now, we have $5 million from New Silver in the system. And I think it's from Friday, actually, we are increasing this to 20 million. And next week on Friday, in the next executive vote, we will be onboarding 4 more assets from Centrifuge. The way that these companies go through this process is, of course, is a little bit complicated because these assets are not permissionless, they don't live on chain. We kind of need to do a lot of due diligence on them. So the whole thing starts with something called a MIP6 application, which is a collateral onboarding application. We use the same application for crypto collateral. So in that sense, like the journey starts a little bit in the same place. But of course, a lot of the things that is needed in the MIP6 in this case is, a lot of stuff around what is the structure of these assets, how do you legally actually get able to liquidate them if needed, and what is everything else around something like this. So of course there's also a lot about like what is like the revenue driver behind these assets, and why would they be interesting for the community to have in the system. After the MIP6 application, there's some community discussion, looking for interest. If it, even if it's there or not, it goes to an on-chain poll. And it's kind of like the first time where the community can signal with their Maker governance tokens if they're interested in having this collateral or not. If they vote yes for this, it moves to basically risk assessment and technical implementation. The risk assessment is done by a risk committee. We also have a real world assets onboarding team. So basically a team that only works with trying to get these things into the system. When that is then finished, we go to the executive vote, and finally we are live. I wrote up top that this is, like the simplified process, because, for the first assets that got added, they've basically been underway since the first MIP6 for, I think it's almost like a year and a half now. Because, when this whole thing started, there was kind of like a lot of processes, a lot of things that needed to be figured out before we could get it in. Because again, this is the first time in history where we're actually having traditional companies borrowing, using their traditional balance sheet from a DeFi protocol. So in that sense, it was a very exciting moment. And right now we are basically looking to scale it up. So it will be very exciting to kind of like see how this develops in the future. And it's something that we believe will be really, really big. So we could have basically the ability to change normal people's lives using DeFi. Whenever we look at the collateral in the Maker protocol, we're really looking to increase market usage and DAI demand. We're looking to diversify the collateral pool, and I think this is also like a very important topic for this specific case here, right? Right now, most of the collateral in DeFi is very correlated. When the market drops, everything drops, and therefore you can kind of like use these types of assets as like a counterweight inside DeFi to be acting as like the rock we need in bad times, right? Another thing is also, when you're looking at the risk mitigation of the protocol, the more diversified the collateral pool is, the less reliant we are on a single collateral type inside the system. And a lot of people, especially initially in the community, they were quite against adding centralized style assets to the system. But you can really achieve a risk mitigation via diversification of the collateral pool. So of course, if you rely very heavily on one type of real world asset, so let's say you only work with one real estate company and they go belly up, that would be really bad because you would have again like a single point of reliance. But if we have hundreds of different types of real world assets, we can go in and do like some risk mitigation by basically diversifying everything in the system, which means that we're able to absorb we have to expect that eventually some of these collateral types could default, but we would be able to absorb it because we have like this massive counterweight of diversified assets that lies next to each other. I would also say like another very important topic here is of course also like the scalability. So DeFi right now is very dependent on very few asset types. We're kind of like at a stage now where a lot of ETH is inside DeFi protocols. I think being able to scale DeFi only using the assets we use now would be a challenge, right? Because unless the prices go up a lot, we can't really increase the supply a lot of, for example, something like DAI or borrowing and lending in Aave. So this way, it's also a way for us to venture into a completely new market that would be able to give us the scalability we need when we want to scale DeFi to the masses in the future. I'm going to go over a couple of the companies right now that is like the main drivers behind this in Maker. So we have Centrifuge. They went live with the first ever real world assets in Maker, in the sense that it was the first asset that DAI was drawn against. DeFi, they're scaling from, or like the Centrifuge, they're scaling from 5 to 20 million this week. And then next week, they will go up to 42 million. So it's not a lot in crypto terms, but it's something that, like over time, we're sure that this is something we can scale up to be very significant. Centrifuge has also been a long-standing member of Maker governance. So, they really like helped to like pioneer the process of these onboarding. So we're super happy to have kind of like these projects that goes in and not just like relies on like the internal work at Maker, because one of the very important things here is that like the decentralization of the process also means that the participants really need to come in and help push this. And then we've been working with them since 2019 on this project. So when it finally went live, we were quite pleased. And to give you a little bit of insight into how Centrifuge works, they basically have what we call like an asset originator. It's basically some kind of company that somehow originates or gets clients in with different types of assets. This could, for example, be a factoring company that deals with invoice financing. It could be a real estate developer where they get financing needs for every single project they have. They're also doing a project that is one of the ones to be on next week, which deals with farmland, so commercial agriculture, real estate. And these companies basically go in and develop some kind of asset, a property, a project, or needs bridge financing somewhere. They take the assets, they bundle them together as NFTs. So each asset is represented individually by an NFT, and then they create these. They have created this like investor contract you can see over here, where basically use a terminology that is quite, or like a system that is quite recognized from traditional finance, which is basically having like a senior and a junior tranche. Maker is borrowing exclusively from the drop tranche, which is the senior tranche. So that basically means that whatever the size of the junior tranche is, we know that we have, like some kind of level of defaults that can happen inside the pool before we would ever be hurt, basically. This creates some kind of like guarantee for both the investors in Maker as well as the protocol itself. Drop and tin is also something that, like with this system, they're really looking to create a lot of innovation in the trade finance space, basically being able to draw liquidity both from the market in terms of the tin tranche, the junior tranche, but also being able to, get a lot of financing met from, Maker. And as I said, like next week, they have these 3 new asset classes. There's another one with real estate, the agriculture one I talked about, and then also trade finance / factoring. And the other real estate is like a flip and fix business where they basically buy up commercial real estate, fix it, and then they sell it. And this is very not much based around revenue-based finance. So whenever you have projects where you either use it as bridge financing, or you can kind of estimate revenues coming in over time. This the projects that is like the easiest for us to determine right now. Also because then you can go in and you can look at kind of what is the revenue-based returns for the asset itself, rather than only looking at price appreciation. Because of course, price appreciation in something like this, which is very illiquid assets, is not so easy to liquidate or put back into the market. It's much easier to do it with revenue. Another one that is working on their onboard, they're already onboarded, they're approved. They're still figuring out the last things as they use a different structure. So they used a Truss Structure in the US. Where they use an external trustee to liquidate, and this is a very traditional way of doing finance. So basically, some similarities can be drawn to the SPV setups we have in Europe, but in the US they have these trust companies that will manage the trust for you, as well as appoint an external trustee. And in this case, they actually have the external trustee has actually agreed, the trust company itself has agreed to basically listen to Maker governance. So let's say that Success Capital stops paying on one of their assets, the trustee would actually be told by governance to go in and liquidate the assets inside the trust. They're doing it with credit and tenant leases. So it's a little bit of a different space, but at the same time, it's also these revenue-based assets. And as you can also hear, there's quite a bit of it is within real estate. Also just because the sizes of the projects makes it something that quite quickly can become quite attractive. This here is an overview of the trust structure. So basically, you have a Maker representatives entity that gets elected. You have the assets in the trust. You have the trustee on top of it that talks with the Maker representative entity. You use also a company in the middle, and in this case it's Success Capital. And then you have the borrowing company who the ones that needs the financing for the credit tenant projects that they're doing. There's a lot of stuff around this. Things are a little bit more complicated than they look here, even though this is something that might not be so easy to grasp immediately. But if you're interested in learning more about these projects here specifically, I would recommend you go to the forum.makerdao.com, where we have a lot more information about it, and you can also go in and see the risk analysis of these types of projects. Another thing, which is the service providers I mentioned earlier, is because, as I'm sure you can imagine, the whole process of actually reaching the stages that both Centrifuge and Success is at now requires a lot of work, a lot of knowledge of the system, knowledge of how Maker governance works, some structures set around the things that they're doing. So basically, we're seeing now the emergence of some companies that is basically basing their business model around helping traditional businesses access DeFi. So one of them I just want to highlight here is Greg DePrisco. He's my former boss at Maker. He was the head of BD, global BD. And yeah, he wants to facilitate governance, administration of reporting, and assurances. The assurance is for the protocol itself, as well as the reporting. Because of course, with assets like this, where you cannot see what is happening on chain, you kind of like need to have these like quite extensive reports done to the community, so that at least can read through it and see that like everything is still okay with the project, the bills are still getting paid, the revenue is not dropping, and kind of like keep like an over time strong risk assessment of what is happening in these businesses. Which also, of course, makes it a little bit some time of a manual overhead. But this is the way that it's working for now. And yeah, like he wants to help guide traditional companies through their times complicated process of onboarding into DeFi, which especially if you don't have any experience in the space at all, is quite a lot. We have seen, I know in the last 2 years, I think I've seen personally around like 15 different companies trying out with the process. And we are only left with 2 right now, which I think also reminds us a little bit about like how the UX or like onboarding into traditional crypto can be. It is quite a lot for people coming right into the space, and especially something like this where you can like base your business around having access to the system. It can be quite a tough setup. But this is of course something that like now when we have the first ones through, a lot of the processes and like the things demanded from them is being planned out and scoped out, which also means like in the future we hope that this will be much easier for the next generation of onboarded assets. Yeah, so like looking at the future, like what can we really expect from these types of projects, right? I think like we have seen already now that like fintech has gone in and started competing with the banks with things like this, and this like where we really want to position DeFi as being like a very, very strong competitor in the financing market. Right now, a lot of the stuff that we're doing still lives like in our own little world, but this would really be like a chance for us to branch out and scale out and access traditional companies. Since Maker also is the creator of DAI, we're quite competitive with the banks. The rates that we can offer them is not determined by the market rates or the central bank rates, but basically where like we see the risk-adjusted returns are good enough for us to participate. Which also means there's of course some industries like real estate in Europe that is quite difficult because the interest rates are so low already. But we do see a lot of potential in some specific sectors where we feel like we can be competitive. The vision for all of this was really something that was described all the way back in the white paper of single collateral DAI. It was described already back in 2015 when the first sketches of the Maker system was put down about not just having single collateral DAI but having a multi-collateral future. And it was mentioned when the official white paper was released back in 2017. So this is something that has been planned from the beginning, which is also why like even though there was a little bit of community resistance in the start, it's something that like the team really has wanted to keep on push through, and where we see like a lot of the scalability. And of course like this was something we worked on before the DeFi summer last year. So last year in June Maker and Compound and Aave and all of these protocols all of a sudden started scaling like crazy. So like right now, like even with the 42 million we're getting next week, it seems like a pretty insignificant amount with the way things developed over the past year. But we also kind of like want to think back and remember that what the bear market was the last time, and know that like if this should come back at us again, maybe hopefully not in quite the same scale. It would be really, really good to have some of these assets in there that really can help us pull through and keep like a decent DAI supply, and at the same time continuously create revenue for the protocol. We also kind of like think that like the way that these real world assets, like with how that things are looking now, it kind of like gives us like some flashbacks back to, like the early DeFi days, where there was a lot of projects, there wasn't a lot of protocols, the usage was very low. But at the same time, we really believe that this is something that could achieve similar scalability and achieve a very, very important role. And yeah, like the excitement for all of this is really that we have like for the first time in history had a decentralized protocol that is not tied to any central authority, user currency, not controlled by any institution or individual, finance, traditional companies, and like changing the lives of everyday businesses and people. So we really see that even with the stage the project is at now, it's kind of like a big milestone for the community and for all the people who's worked on this very hard. Because all of a sudden we have these protocols that not just can like change the life of people on the currency side, but can actually go in and help their businesses and improve their businesses. So this is something that is very exciting for us at least. Some of the other things that we also are seeing now in the space is that we're seeing that there's more of these platforms here that is looking at innovating the way that we buy and sell securities. So this is also like a pretty early stage market, but we're already having some protocols that became, or like projects or teams and protocols that both became regulatory compliant. So for example, Fountain, they operate in Liechtenstein where they got the approval to operate. Swarm Markets got approved by FINRA in Germany. And they're allowing for buying and selling security tokens. So like one of the big problems that we're seeing with the other type of onboarding of real world assets is that they're very illiquid. And there's a lot of the security assets that actually are traded in traditional markets that we are sure that is a big desire to trade, but it hasn't really been innovated around in regards to how this would fit into the crypto markets or in DeFi. So basically, for example, Swarm, they're using balancer pools to create kind of like a minimum level of available liquidity. And what the dream for something like this would be that eventually they would have built up enough liquidity for DeFi protocols to actually create liquidation markets on top of these systems. So we basically could adopt security tokens in form of, for example, like bonds or stocks that traditionally are very liquid, but in crypto not liquid at all. And if we get the liquidity up and running, then we could also again use this as collateral in the systems. So I just think that this is still like quite early stage, but I figured it would be like a worthy mention because I hope a little bit down the line that we would see enough activity on some of these projects here for them to actually come in and participate in the DeFi system. And of course, like one of the big reasons why we have these companies that is now, approved by regulation and like that they go this route is really that, like security tokens needs compliance. There's still some, uncertainty around some crypto assets, but a security token, there's a lot of certainty around what it needs. And it really, if we want to work with companies that specializes in tradable securities, we really need the compliance to be on top. So therefore, it's also good to kind of like see how some companies are building wrappers around stuff like this, so it can actually be created. You actually can create, for example, liquidity pools with security tokens inside of them. The cool thing about these two projects, this is from Fountain, this is from Swarm, is that they're both taking a non-custodial approach. So they actually take an approach where it's not just like a siloed and custodial platform, but they actually still allow people to hold some kind of like custodial ownership over the tokens themselves. They both function like peer-to-peer, has interoperability with DeFi protocols and so on. So it is something that I personally have pretty high hopes for down the road. So basically, like I also mentioned earlier, that we kind of like have some hopes that this could represent a little bit of like the similar growth that we have seen in DeFi. Like over here we have like the die graph of like the supply, or like the market cap, and over here we kind of like have like exponential growth versus linear growth. And I think like one thing that we really see with these things here, where we use very complex infrastructure, is that a lot of things needs to be built out, where we see like a growth level which is like very underperforming, right? So I think in like many of the assets, many of the things that we've seen in the crypto space, for example, also with the whole NFT boom that we have been seeing, is that we see like a long time where it's actually underperforming, right? So we're sticking around, we think all of these cool things are being built, but the market doesn't really move. There's not really that much interest for it. But then the thing is that like once these very complex systems are built out, you can actually achieve like exponential growth. And this is something we've seen in advanced technology quite a lot. I think some of the other thing we see, for example, with electrical cars, where they were like so bad for such a long time, then all of a sudden it kind of like actually hits a threshold where people think, okay, this is something that I actually want to use. And in general, this is something that can be applied to a lot of technologies, both physical and digital technologies. So with these real-world assets, we have these like complex structures, complicated mechanisms around it, and I believe that all of this is being built out. So we are seeing a little bit of growth at the beginning, but once all of these things get like normalized and manifested as like standards in the space, I hope that we will see a similar growth as we see on both of these charts here, where we could experience in exponential growth. And of course, the same as with anything else in DeFi, we kind of like have this like constant innovation from very strong teams, and this is something that I think all of us can reflect. So yeah, just like a couple of final comments. With the whole real-world asset DeFi, we really want to enable the decentralization of these systems, not through only using decentralized assets, but actually using diversified portfolios. I believe personally that like if you look at the traditional market, like traditional finance, like right now you have almost endless possibilities. There's so much stuff going on. And if we can just capture like a fraction of that, in the beginning at least, we would be able to really make it count a lot. The good thing about using protocols, for example, such as Maker, I can only really speak on behalf of them, but I know Aave, for example, also has looked into these things. I think it's with Realty. It's basically we can take these types of assets and we can bring a level of transparency and trust that we haven't really seen in traditional finance before. We kind of like bring them out of like the black book. Once they sit in traditional financial institutions, we bring them out into the public, out into the open, where they're not just getting evaluated by individuals sitting inside a bank or some other lender, but they're actually being evaluated by a community, and the entire community can kind of like gather around verifying these systems together. And also, yeah, I think I mentioned a couple of times already, but like scaling DeFi to grow with non-crypto native assets or non-native crypto assets is something that could give us like the next kick of growth in DeFi. Because the current market situation in DeFi is really that most of the stuff is backed by the same asset classes. So that was basically it. Thank you guys for spending the last time of the day here with me, and here's my contact details if you guys want to reach out to me. And I don't know if we do questions here. Yeah, we can do questions if anyone has some.
So the 3% yield, I think it was on like the invoice thingies from like Centrifuge, right? Or 3% yield. I think that seems like quite high compared to like what you traditionally sort of would get now on like US dollars in the market. So why, like, because the 3% seems so high, like why aren't like banks just sort of lending to those companies at 3% if the risk is so high? Is it actually quite risky, or is it like a reason why it's just not worth the effort for banks to provide a financing at seemingly high rates for those things?
So I mean, like invoice financing specifically is actually very expensive traditionally. We have, for example, a very successful Danish startup where they're lending it out at 1.5% per month. You get like basically like a bridge finance, you know, or like you get like typically like a 90-day financing for invoices, and they charge, you know, like 4.5% for that. One of the big things with banks and why fintechs are starting to like eat away at this is that like the banks, they have a lot of regulatory requirements about like the risk profiles and classes that they can have on their balance sheet. So basically, you know, like they're not allowed to have that much exposure to stuff like this. And also, like if you look into like invoice financing, it's often been called like, you know, it's more close to like almost like predatory lending, because you of course have some like very solid companies that, you know, just wants like this financing, but like you often have like kind of like the players that, you know, who really needs the liquidity, who really wants to pay for it because, you know, they need to basically like finance their own business over the next 90 days. But the thing with invoice financing, for example, is that like often it's not the most of the time it's not the small business you have the counterparty to, because, you know, they would basically send goods to like a bigger company, be the supplier, and the bigger company would then be the one who have to pay them. So you're actually like you're paying as if it's the small company's credit rating, when it's actually like, you know, them supplying to like, let's say like BMW or Nestle or Lego or something, like a big company that has like the finance in check. So that's why like you see the invoice financing generally is very expensive. There was this report given out in Australia that they saw like most of the rates for these companies was between 24 and 36% per year, which is, you know, like ludicrous, especially, you know, when the counterparty is, you know, often the bigger company, right? So invoice financing is one of like the verticals where I believe we could do a lot of good work. Of course, like you need some stuff to manage around it. Another thing is also that like we don't give the people in DeFi in this case 3%. I can't remember exactly what it is, but you basically have the two tranches. So the junior and the senior tranche, and the junior tranche, they take they take the first, you know, basically like 15% default risk typically. So there's like a minimum cap of like how much it needs to be, but typically it's between 10 and 15%. So they of course get a higher rate. So, you know, like you could imagine that like they would get paid 8%, and then like the senior tranche would get paid 3%. But that also means that like the senior tranche would basically have a 10% of the, you know, invoice portfolio needed to default before they would take a loss. So you kind of like divide it into that, and then of course you give the lower tranche better rates. But yeah, like invoice financing is like actually one of the ones that you know we could be very competitive in.
Okay, thank you.
Thanks, that was a really helpful talk. Do you have a view on the regulatory outlook with regards to all this? I mean, obviously, securities, the security tokens one is the big one, but also on the real estate angle, do you think it's a major rate limiting step, the rate at which regulators get comfortable with this kind of interface between the real world and DeFi?
Yeah, so I mean, like in all the setups that we have seen so far, like both Centrifuge as well as Success Capital, they actually just completely mimic, you know, like how a traditional company would do it. So they use like most of the same mechanisms with like minor changes that doesn't have any regulatory implications on the setup. So, you know, like for example, 6S, you know, where we have like the trust structure, that's like a very common way of you know, basically lending out to people. So you pledge the assets in a trust structure. We have a trustee that has the ability to go in and take over. So like if they stop paying, you have this like external third party that, depending on the terms in the trust, can go in and liquidate it. You have similar structures like Europe with the SPVs. And the same, you know, like with Centrifuge, you know, they only take in accredited investors when they have like investors going into the pools, comply with all the local securities regulation, because Centrifuge, that is, you know, like it becomes a tradable security because they tokenize it, right? So like right now, most of the stuff that is being done is actually just like it's mimicking everything in the traditional system. And, you know, you could even like, if you're even worried about, you know, having money coming from a DAO, you could have like a company that would basically like be the minter of the DAI and just send it into them with like with a contract between the two, and then you would just have something that would like completely mimic how like a traditional business works, except that like the flow could come in stable coins, but you could also let it go via like an OTC and just send them USD, which is also like actually what most of the companies want anyways, right? So in most of the setups, they never receive DAI. They just receive USD in their bank account, and everything rest is just like a structure around it. So it is like a lot about creating like the correct legal structure, which is also like when I show the onboarding process, it's like this is like a very simplified version because there goes a lot of thought into how do we create a structure where we could actually do these things without getting in trouble with the regulatory bodies, but basically just mimic some things that we know this is how it works in finance in general.
And what about the security token side of things? I'm curious to hear your thoughts on that.
Yeah, for sure. So, for example, Fountain, they have gotten like an approval letter from the regulator in Liechtenstein to do like a completely decentralized peer-to-peer exchange with security tokens. Swarm, they have a little bit of a different approach. So they are basically creating like an environment where I think they're using like an NFT as like an approval method in your wallet. So like unless you have this NFT, you cannot participate in the pools, you cannot hold the tokens. There are kind of like some restrictions around it. So like again, like with the security tokens, they're not free floating as like a standard ERC20. You would need to have some kind of like KYC and accredited investor approval around the tokens themselves. And this can of course also be like a little bit complicated with something like Maker, because like there we would need to know that the token could actually be inside a vault if we wanted it there, and the vault, because the vault basically takes custody of the tokens and cannot be KYC'd. So until we get to that stage, this is at least like good enough for now in regards to like them trading. But we hopefully at that point figure out some way of it, and you could kind of like almost say that it shares similarities to the Aave institutional pools that they will be launching, where like all participants in the pools are KYC'd. It still uses permissionless protocol below. They might have some permissions around it though, but like you can only interact if you are actually like KYC'd in this network.
Thank you very much.
Hey, thank you for the talk. Also on behalf of the YouTube viewers who are voiceless. I had a question about the cost of onboarding. If you onboard parties like Centrifuge, Success Capital, that's a human process. Also, monitoring the quality of the collateral in the future is a human process. That costs money. How is this cost accounted for? Who pays it? And at what point in time does it become too expensive?
Yeah, so I mean, and shout out to Centrifuge and Success for this, but like they took on, to my knowledge, most of the cost in doing this onboarding, right? They kind of like knew it was a tedious process to go through, but really helped push the innovation of that front as well. Going forward in the future, hopefully there'll be done more work around figuring out how to potentially cover some of these things here, right? But things such as, for example, like the accounting and the reporting, like all of these things that needs to be produced for the DAO to keep the asset in there. That is something that you would basically need to calculate on adding on top of your rate, right? So like if you get a discount compared to the banks of like, let's say 1.8% or something, or 1.5%, and that like the cost of having these things running would be 50 basis points. I think it's something like that, for example, real world assets co would charge. Then you would basically be able to just say, okay, does this make sense for us as a business decision? If your discount is smaller than 50 basis points compared to a bank, then you wouldn't be able to do it in a meaningful way where it would actually make sense for you. And of course also now like the onboarding has been very long. So of course, like the companies that went through it now, they incurred quite some costs on this front here. But this is something that like we're working quite hard on to figure out how we can like ease. And I would also say like a lot of the scoping on some of these structures has been done now. So hopefully that would also ease the burden of work on the following companies. Because basically, so the way that like Maker works, the Maker governance works in this sense, right, is that like you basically present like a structure or like a setup, and like if they become comfortable with that setup, they would be able to improve that setup in all the scenarios as well, right? So that is, for example, like the first Uniswap LP token we onboarded as collateral. it took a little bit longer, but as soon as we had the first one onboarded, the next 10 became very easy. So, in that, the same with some of the altcoins, it's kind of like once you get the ball rolling and the community is comfortable with a specific setup or asset type or asset class, like the subsequent onboardings will become much easier because it's basically just replicating the things that we like about the first one into like the new structures. So I can't really give you like a number on like when it wouldn't be beneficial to do, but like if you don't want to do it yourself, there's like gonna be possibilities in the future, where you could like outsource that, and then it's just a business decision, like how much cheaper is the rate we could get at Maker compared to the other asset classes under that level, and how much would it cost for us to potentially have someone helping us with it, or just doing it ourselves. All right. If there's no more questions, I want to thank you all for your time, and I wish you guys a good night, and I'm sure you will all have a blast. Thank you.